45 years for silver to break 50. And then I believe that was either October or November. And then it basically did a double and a half in a 2-month period.
Yeah.
What specifically happened then? There was obviously issues at LBMA and elsewhere, but what do you think drove that price like it did?
I don't think anything drove it except what had not occurred for 50 years. We ran some charts last October. Silver was emerging above that old dual set of highs at 50 bucks. 1980 was a high at 50, the bunker hunt era. And in 2011, it hit 50 again. Range. This chart doesn't reflect it because it must reflect like weekly closes, but intraday, both highs were at 50.
Right.
In 1980 and 2011. 500 bucks, okay? And if you go to 2011, when you were at 50 bucks and do the same thing, you'd be owed 200-300, okay? So those sort of broad, non-technical but fundamental driving forces suggest that, hey, if silver's merely going to reflect, not even outpace, just reflect the decay in the buying power of the money unit, it could go there, okay? Copper did, lead did, gold continues to beat the growth in the money supply, but silver lags it. Why? And I mentioned an example of this that everybody should think about. When your granddad built a house, it was $4,500. When your father built one, it was $45,000. Now a median home's $450,000. You get the point? It's the decay in the money unit. All assets over time will tend to follow that decay. Now some will lag it and catch up. Some will exceed it in 45,000. Now a median home's 450,000. You get the point? It's the decay in the money unit. All assets over time will tend to follow that decay. Now some will lag it and catch up. Some will exceed it and pull back. The S&P, for example, which everybody's touting because they're quote new highs, which is limited, by the way, to the S&P 5, not the 500. If you go back to 2000, dot-com high, check where the money supply was, check where it is now, do the math, do the same thing with the S&P, you'll find the S&P nearly reflected the decay in the money unit, or the increase in the money supply. It didn't do any better. So in real dollar terms, converted to assets other, like, you know, how many loaves of bread could you buy in 2000 with an S&P, and if you sold, and how many now? It hasn't changed. It really has not gained value. It's the clock and say, well, let's give it 3, maybe 4 months, but basically expect much of what's going to occur that quickly.
Okay, so you expect for silver investors, the next 4 months of life are going to be quite exciting, beginning within the next month.
Once we get our trigger elected, yes, that's when I pound the table and say, okay, light green again. Now the light never went dark on long-term metrics. They just had a dip, okay? But it's the shorter-term stuff, the stuff that when you break it might kick you in the gut for a couple months or so, which it's done. Okay, silver's been stalled for several months sideways after the break. But that looks like it's about to end, and it's going to wake up. And fortunately, during that process, the market has gotten rid of a lot of weak longs. It's created a lot of doubt. A lot of people say, I've got to go back to 50 now. Gold's got to go back to 3,500, et cetera, et cetera. And that's what you want like that we're arguing. It's usually because the doubters have prevailed and now suddenly rejoin in an orgy-like manner, okay? And the public that's never been involved in silver and gold, especially the Western public, U.S. public, a lot of other parts of the world are, will want to join in. But at that point, the market's lost its sellers. They've already sold. Oh. So you get what? A wet bar of soap phenomenon.
Well, it certainly means it should be in line for an exciting summer. And Michael, here's an interesting one that I've been excited to ask you about. As I heard your forecast and then listen to what you were suggesting, guess when I thought about what would be required, I mean, in terms of what we saw when you were saying why specifically last year, I think there's a degree to which those deficits added up, and we did have those actual.
What Michael Oliver just said should stop every investor in their tracks. The Momentum Structural Analysis founder is calling for an explosive move in silver, suggesting it could hit $300 to $500 an ounce this summer. Now, think about that for a moment. Silver took 45 years just to break $50, and Oliver is predicting a tenfold increase in a matter of months. He argues that when you adjust for the buying power of the money unit, silver's 1980 peak of $50 would be equivalent to $45,000 today, while a median home is only $450,000. This stark contrast highlights how deeply undervalued silver remains. Oliver isn't just talking theory either. He's got skin in the game with his personal portfolio, about 50% silver and 50% silver miners, unlevered. He's been actively moving money to back this conviction. But what Michael reveals next changes the entire picture as he explains why this isn't just a prediction, but an inevitability.
In 2007, warning you that something's going on in the financial sector. And yet S&P's up there beating its chest like, oh boy, I'm going forever. Okay? I think we're in a similar situation right now because the financial sector has blown out multi-decade lows this month relative to the S&P. Which if you bought the XLF as opposed to the S&P, you're way behind. S&P's leading. And the only reason for that is a few sectors within the S&P, like semiconductors and AI, are causing that leadership. It's not like there's 6 sectors that are doing it. It's one, tech, okay? Industrials aren't beating it. They're going down relatively.
And only a small number of companies within that tech sector.
Yeah. So in other words, I call it the S&P 5, okay? That's what's making new highs, okay? But nobody's aware that all you hear is, oh, the market made a new high. No, the market, quote unquote, did not make a new high. S&P 5 did, okay? But when you go to all, I think they're going to explode relative to gold. Explode. And again, it's a valuation issue. You go back to the 1980s, 90s, 2000, and you look where XAU index was in terms of its price relation to gold. It was oscillating sideways in a broad range, but the average value of XAU divided into gold expressed as a percent was 25%, which it was about 25% the price of an ounce of gold, XAU price, okay? Up and down, not up and down, but at that level, that zone. It broke down in 2008. It collapsed by 2015 during the gold and silver bear market. The miners collapsed too, but more. They dropped to 4%. Okay, this is a sector that used to have 25% of the value of an ounce of gold as its price divided into gold. It drops to 4%. I mean, what are you going to do? Go to zero? I mean, that's called free.
I think the second half of 2026, what I think will be truly fascinating is seeing how the Fed juggles the fact that inflation's already going up. You have the higher energy prices when, I know Trump was drooling basically to get interest rates cut. So how they're going to navigate that. I heard you mention, I believe you've said you think we're going to get some rate hikes, which...
No. Rate cuts. No.
That they would be cuts.
They'll respond
cuts first.
Because they have to.
Yeah.
Even if it's not their mandates, the implicit mandate is you've got to defend the government bond debt market. If you don't, the house burns down. So you've got to get the hoses out. By the way, I didn't answer your question before. What do you do after the move occurs in silver? Okay. Yes, what I plan to do is take some profits, but I'm going to put it in cash. And by cash, I mean gold bullion. Okay? I think you're going to a new reality, and I think you're going to be up there. Yes, you'll have some sharp corrections, but you don't control all the money. We're allowing gold and silver to be used as money. So things like that will occur, but what will spark that will be like a government debt crisis, a stock market rollover, which we're expecting, and ultimately a bear market. Those kind of things will shake and rattle the average person and government agencies. We'll go to a new reality, I think.
Yeah, we've seen Hank Paulson, Jamie Dimon, some prominent in the Wall Street
Yeah,
community
yeah.
voices warning about that. And in either case, Michael, I sure thank you for making some time to dig into this today. And I will pull up your site and perhaps just you could let folks know the best way to stay up to date on your research in what certainly could be quite an exciting next couple of months.
Mm-hmm. OliverMSA.com. Yeah. Take your time. We have an unorthodox technical methodology. And we
Michael Oliver just said, we could see $300 to $500 silver this summer. Let that sink in for a moment. He's talking about a metal that's been trading under $30 for years, and he's not alone in seeing this kind of explosive move. What we're hearing across the board from analysts like Oliver and from veterans with skin in the game is that the paper market for silver is completely detached from physical reality. The kind of price action he's talking about isn't just a rally, it's a repricing that reflects decades of irresponsible governments recklessly printing money and a market that simply can't find enough physical metal. What happens when the buyer of last resort stops showing up or when the true supply-demand picture finally breaks through? We're talking about a physical short squeeze that could make the NASDAQ-style crash looming in other markets look tame by comparison. This isn't just about a potential profit. It's about preserving your wealth in a world where central banks are draining the vaults, and the biggest bubble in human history is getting ready to pop. Silver, as many are now realizing, is the ultimate refuge, an exit ramp from dollar-denominated metals pricing. So the real question is, do you want to be the person who understood this early, or the one who explains it to their accountant later?